This week on Follow the Money Radio, as U.S. stock prices soar higher in 2017 under President Trump, we examine the reasons behind the ongoing uptrend and why U.S. stock prices could climb much higher before the next inevitable collapse. And in this week's trading tip, I'll share 6 rules for identifying and selecting successful growth stocks to trade and invest in. Later, Tom Cloud provides an update for precious metals investors, and Christian financial advisor Mike Mitchell shares 5 basics for establishing a sound retirement plan. All that and more lies straight ahead. Friends, my name is Jerry Robinson. I'm a Christian economist and an investor with the heart of a teacher. So hop aboard and buckle up, because the train is departing the station. All right, friends, welcome to you all around the world. So grateful to have you here on Follow the Money Radio. Well, if you haven't noticed, lately the U.S. stock market has been roaring higher since the election of Donald J. Trump as the 45th president of the United States. The S&P 500 has risen nearly 17% in the 11 months since Election Day, and the top appears nowhere in sight. So what is behind this massive surge in stock prices? Well, that's been one of the big questions we've been receiving here at Follow the Money is it too late to invest in U.S. stocks? Is it too late? Well, let's talk about it. Actually, when we talk about this current market rally, we really need to remember that its roots are in 2009, in the wake of the 2008 global credit crisis. It was in that year, specifically in mid-March, that U.S. stocks officially bottomed and began surging higher. Since the 2009 lows, the S&P 500 has risen more than 200%. And based upon the reaction of U.S. stock prices to the Trump administration, we believe that there is much more upside ahead. Now, that, of course, is barring a few things, namely any kind of black swan that could arise. And also, of course, we have to keep in mind that there is an investigation against the president, and if we were to see impeachment proceedings begin or something became evident that might happen, we could see a violent reaction in the Trump trade. But barring those two things, which seem fairly unlikely right now, we believe that there is very likely much more upside ahead. Now, some suggest that U.S. stock prices are simply enthused or jazzed about President Trump's pro-business stance, but the answers are much deeper than that. For example, consider the price performance of the big 6 bank stocks since the 2016 election. For example, Wells Fargo is up 15%. That's not necessarily amazing, but at least it's keeping pace with the overall market despite recent scandals with that bank. But what about Goldman Sachs, ticker symbol GS? That's the nation's top investment bank. They're up 26% so far since the election. And then there's JP Morgan Chase, which is the leader in foreign currency trading here in the United States, which is up 33%. Or Morgan Stanley, ticker symbol MS, which is up 35%. And then finally you have Bank of America and Citigroup. Both of those stocks are up 44% since the election. So if you want to know what Wall Street thinks about the Trump administration, the answers are right there in black and white. Wall Street loves President Donald Trump. But why? Why do the banks love Donald Trump? Well, for one, let's take the most obvious one, is that he's a billionaire. And he has many billionaire and multimillionaire friends. And Donald Trump, the bankers have a fellow elite who, like themselves, are pro-business. In Trump, the rich have an advocate who holds the reins to the country, but without appearing to be beholden to any particular political ideology or many of the lobbyist groups that infect Washington. Instead, he appears to be flexible. He's pliable. That's something that Wall Street can work with. Another reason Wall Street loves Trump is because of his promise to roll back regulations that were imposed after the 2008 stock market crash. And those regulations were designed to stabilize the system, but they also annoy Wall Street. So put simply, Trump is cutting government red tape for industry, and for that reason, Wall Street really likes President Trump. In addition to signing a sweeping executive order that calls for a complete reorganization of the federal bureaucracy, President Trump has also installed numerous Wall Street titans into his cabinet, ensuring that the big banks always have the ear of the president. Now, according to the Competitive Enterprise Institute recent report, it's told us that Trump has issued 58% fewer major and costly regulations than former President Obama, and he has slashed the Federal Register, which is this huge rule book in Washington, by 32%. Wall Street is also excited about Trump's plan to cut corporate and personal tax rates. Because stock prices are largely a function of personal tax corporate earnings, it's only logical that if publicly traded companies pay less in taxes, it's going to boost corporate earnings across the board and thus the price of U.S. stocks. So, too, a reduction in personal tax rates will almost certainly lead to a significant boost in personal consumption, which means individuals will have more money to buy goods and services from publicly traded companies, which will serve to boost corporate sales. All right, so what else does Wall Street love about President Trump? Well, they love his promise to spend $1 trillion on infrastructure. Many of America's roads and bridges and public transit systems are under massive strain. Many others are in very poor shape. By pouring $1 trillion in taxpayer money into America's infrastructure, this will greatly enhance and improve the many sprawling corporate supply chains that drive our national economy. Then there's Trump to allow U.S. companies with corporate profits, let's say tucked away offshore, to repatriate those trillions of dollars, but at a one-time ultra-low tax rate. Now, this has been argued and bantered about and debated about for quite a long time. U.S. multinational corporations literally hold trillions of dollars in offshore tax shelters. According to a 2017 report by Oxfam, the 50 biggest U.S. companies, including global brands such as Pfizer, Goldman Sachs, GE, Chevron, Walmart, and Apple, these top 50 companies have $1.6 trillion with a T stashed offshore. So that's a tremendous amount of money that's just sitting overseas that's not being used. And right now, the government prevents these companies from using this money for the purpose of stock buybacks or dividends to shareholders. So these trillions of dollars are just stuck offshore. No taxes paid on them. And while you break your back for the tax man because the system is rigged, these corporate giants are holding trillions of dollars offshore, not wanting to pay taxes on them. So if Trump is able to make the offer sweet enough, much of these trillions of dollars could come pouring back into the U.S. economy and could lead to even more domestic investment, which will ultimately boost stock prices. Now, the last time the U.S. did this, Washington did this, they had a tax holiday. I believe it was back in 2004. Almost all of the money went straight to stock buybacks and dividends. So this was huge for shareholders. So if we do get a tax holiday for many of these offshore holdings, it's going to be a boon for shareholders in the stock market. Then there's Trump's banking reform plans, which includes gutting the Dodd-Frank financial regulations that were put there in place during the Obama administration. And the plan is to replace it with a much less restrictive law. It's the Volcker rule in particular, that provision in the Dodd-Frank bill or the act that Wall Street really wants to eliminate. The Volcker rule restricts the United States banking community from making certain kinds of speculative investments that do not benefit banking customers, such as the kind of speculative activity that these same banks engaged in just prior to the 2008 stock market crash. But just last week, U.S. Treasury Secretary Steven Mnuchin announced a decision reached by the Financial Stability Oversight Council, the FSOC, that the insurance giant American International Group, they're better known as AIG, basically had a decision that said that AIG should no longer be considered too big to fail. Now remember, this is the same AIG that got a $182 billion taxpayer bailout just to survive its own reckless investments in the 2008 economic crash. Put simply, AIG will no longer be subject to a host of federal regulations and oversight of its internal practices and acquisitions, thanks to the Trump administration. So too, we are witnessing the revival of a certain type of derivative right here in 2017, known as the synthetic collateralized debt obligation. These are known as CDOs. Now, this type of derivative, which is being revived in particular by Citigroup, played a massive role in the 2008 economic crisis. But they are becoming increasingly popular amid our low interest rate environment, which many institutional investors are not expecting to improve anytime soon. When interest rates are low, which is the same thing as saying that the cost of money is low, it often drives investors into riskier products like these CDOs, these collateralized debt obligations. And so we have two immediate lessons here. First, we have another proof of a monetary law that you should commit to memory, and that is that money always flows to the rate of highest return. Very important economic principle to understand, a monetary rule that's hard and fast, that money will always flow to the rate of highest return. So when interest rates are low, you're going to stoke risky investments that pay higher returns because that's just simply a monetary law. The second thing to keep in mind, or the second lesson here from this, is that derivatives, which were originally designed to manage risk, to mitigate risk, if you will, and to increase market stability, can actually cause more harm than good. Derivative markets are global, but the U.S. is the only market in the world that separates derivatives regulations from equity regulations, which is why the SEC issues and enforces equity regulations, and the CFTC, the Commodities Future Trading Commission, monitors the U.S. derivatives market. Now, this is largely due to the sheer size of the U.S. derivatives market, which is the largest in the world by far. In fact, it would be impossible for you or I to obtain a 30-year fixed rate mortgage, for example, without the derivatives market being so sophisticated, the derivatives traders smoothing out the wrinkles in the overall market. So we really do benefit from the derivatives market itself, but it is really also a major problem that led to part of the 2008 crisis. The CFTC president just recently, underneath President Trump, had stated that it's time to let financial institutions self-report their own violations. So you have, in essence, a loosening of regulations in the derivatives market. This is very dangerous, of course, and we see the revival of these CDOs right now. So this is kind of a problem. At the same time, because we're seeing the loosening and the lax nature of some of these rules, that's going to foster some growth for a little bit of time. The speculation and the froth may continue for quite a bit longer before we inevitably hit a speed bump or eventually run into a collapse, which we believe will eventually happen. So banks are loosening up their lending standards. And just according to a recent press release from Fannie Mae, listen to this. I'm quoting here from a Fannie Mae press release dated September the 25th. It says, facing constrained mortgage demand and a negative profit margin outlook, more lenders say that they are easing rather than tightening home mortgage credit standards, according to Fannie Mae's third quarter 2017 Mortgage Lender Sentiment Survey. Across all loan types, the net share of lenders who reported easing credit standards over the last 3 months reached a new high since the survey's inception in March of 2014. So in essence, what we're seeing is that banks are getting a chance to now possibly self-regulate themselves, self-report their own crimes, right? And then on top of that, we have banks loosening lending standards to potential borrowers who want to borrow for real estate. In essence, we're repeating the same mistakes of the past. I mean, we have real estate prices soaring around the country. We have the Case-Shiller U.S. Home Price Index now above its pre-2008 housing bubble peak, and we have interest rates near all-time lows. Banks are loosening lending standards, which will inevitably lead to yet another wave of defaults and foreclosures when interest rates eventually move higher. So when you couple this with the deregulatory trend that is accelerating under the Trump administration, it's quite easy to see why the next financial crash is going to be much more severe than the last, and quite possibly the worst in our lifetimes. But we appear to be in the early innings of Trump mania on Wall Street right now. In fact, expectations are still very high, and the best historical 6 months of the year for stocks is just beginning to start. In fact, there's an old adage that says sell in May and go away. You might have heard that before. Typically what you will see is a tremendous amount of money flow out of the stock market in May. And during the summer months, we call them the summer doldrums, people tend to be out of the market, traders aren't as active. And then in November, we tend to see a large re-injection of those funds back into the market. So demand rises. So if we can get through the month of October without any major crash, which, again, it's hard to see what would spur that crash right this second, aside from a black swan or, as I mentioned earlier, some sort of impeachment proceedings being announced against Trump that could stop this deregulatory trend, then we're very likely going to see a strong rally into the end of the year. You know, the last time the stock market loved a president this much was Bill Clinton. In fact, that's whenever I cut my own teeth as a trader, was during the Clinton administration. President Clinton deregulated Wall Street by repealing the Glass-Steagall Act. The Glass-Steagall Act was a Depression-era banking regulation that separated risky trading and investment from traditional banking activities like business lending and consumer finance. It was passed in 1933, but then it was repealed by Clinton in the late 1990s. And banks went nuts, and they started getting involved in all kinds of risky activity. And then, of course, we had the dot-com crash. So the bottom line is simple here. Wall Street loves President Trump, and that means that under his watch, we can expect stocks to continue climbing higher. Now, the inevitable crash will come, but if history is any indication, and of course, barring, as I mentioned, any black swan events, the stock market under Trump likely has much more upside before the bubble event when essentially bursts. Now, when this bubble bursts, it's going to be interesting. How do you think people will react in the next major market crash? When the stock market begins to crack, in which direction do you think capital is going to flow? Well, when we look back at the 2008 crash, we saw a lot of money flow out of the U.S. stock market. And where did it go? Well, it went into bonds, right, which is a very typical thing that we would see. Fixed income began to receive a lot of demand. That's a typical safe haven. We also saw money pouring into another perceived safe haven of gold. So gold certainly benefited from the last crash. And we also saw some money pour into foreign markets. But there's a new asset class since the 2008 economic crash that I think I want you to focus on a bit more than perhaps you might be, and that is cryptocurrencies. We really believe that after the next crash, people are going to feel jaded. They're going to feel jaded by both Wall Street. They're going to feel jaded by the fact that this has happened again. And you got to think about this. If you are 65 and listening to this broadcast, you have money in the stock market, and the stock market just crashes, right? How are you going to come back from that if you have a lot of money in the stock market? You've got to be prepared, right? And I think that what we're going to see is that as the market begins to pull back, once we actually reach the apex, wherever that is, and based on what we're looking at now, we think that may be a few years out based on what we see. When that does eventually happen, we think that money will not only flow to bonds, not only flow to foreign markets, not only flow to gold, but we think we're also going to see a big influx into cryptocurrencies, Bitcoin. I think these are areas that you want to be focused on. We've done a lot of teaching on cryptocurrencies. In fact, we just did a really good teaching, Cryptocurrencies 101, basically understanding them, and then secondly, how to buy them. We use a few different platforms to do that. So if you're interested in learning more about that, become a member. Go to ftmdaily.com/subscriptions, and you can become a member and get access to hundreds of hours of training videos to help you become a better investor and make more income. Now, let's head over right now to our good friend Tom Cloud for an update on precious metals.
Not a whole lot going on. I just continue to encourage each of you to read about the potential of a gold, silver-backed cryptocurrency and what it would do. I also want you to read what's going on. Not only is China buying up vast amounts of gold, getting ready to offer this yuan or gold for oil with the House of Saud in Saudi Arabia. This is a game changer, and certainly there's a lot on the internet to read, and you should put in the search engine and read about it because it will drastically affect the precious metals market, especially gold and silver. So you need to be doing that. But the other thing that's just come out is the amount of gold that China and Russia have some kind of agreement not to come out until they both have the amount of physical gold and silver they want for reasons of backing a currency or partially backing the currency. Another game changer. And then certainly we remember here a few weeks ago when Munchin, the Treasury Secretary, visited Fort Knox and made no comment on the 8,163 tons that we supposedly have. Either way, it is there, it's not there. So we really still don't know, since there hasn't been an audit since President Eisenhower in 1952. Quite a while for us to own gold as a country, and us, the taxpayers, own it, and we can't get an audit on our own investments. There's a lot of this stuff that's stewing up, and it is going to force the hand as we go. This morning, October 4th, 2017, we wake up and our president, in his words, want to wipe out the debt of Puerto Rico. Isn't that interesting? $100 billion plus. Just wants to wipe it out. Look at the bond market. As you look at this, is what's happened to bonds that are triple free tax. In other words, if you had your own Puerto Rican bond, you weren't paying tax in the state, the country, or in Puerto Rico. You had 3 exempt things on these debt. Look at the value of them today, just to get a little taste of people putting money into a mutual fund of bonds or buying the bonds individually, and they wake up overnight on one statement and 30 or 40% of their bond is wiped out. And it's going to be a massive sell-off as Trump tries to figure out how to pay off this or wipe this debt out. So these things, we have to realize that Trump just raised the debt ceiling, not 1 trillion, but 1.25 trillion, 1 trillion, 250 billion. No president in the history of the civilization has done that. And then to come out and present a budget saying he's going to cut costs, and he raises the budget to over $4 trillion. Let me put that slightly in perspective for you. In 1980, we got Jimmy Carter kicked out of the presidency. He had a $500 billion budget. So now Trump, only 37 years later, has a $4 trillion. So the size of government's gone up 8 times in 37 years. But what's worse, the debt's gone from a worldwide debt of 5 trillion to over 65 trillion, of which 20 plus trillion is the United States. We're 1/3 of the whole debt of the world. We're the largest debtor country in the world. And yet, we just keep printing money, keep printing money, keep printing money with nothing to back it. And you, the investor, sit there thinking happy days are here again. And there's going to be a middle class tax cut. It's going to give you an average of $1,000 more. But they're going to increase the money supply much more than that. So we just need to be doing our homework and following these things because they are devastating what is coming. There's going to be many debts rolling over, not just down in Puerto Rico. And you're going to see defaults like you've never seen defaults in the bond markets as we go forward. So all I can tell you is you need to have your vision on this and get into the percentage you want in precious metals before all these things happen, when there are cryptocurrencies backed by gold and silver and tons of physical gold have to be bought to back that. You want to be ahead of that wave. Why is Russia and China buying gold so quickly? They tell you they're going to have some kind of backed currency. Will it be the yuan or another currency? I'm not sure. But it is going to happen. And we're not talking about years down the road. We're talking about literally a few months. So hopefully this will give you time to read more about this stuff on the internet and get more familiar about it, because it's going to be with you the rest of your life. If you need to reach us, you can reach us 800-247-2812. And either Dan, Kathleen, or I can discuss it. If you are looking to roll over and have a self-directed precious metals IRA, we'll walk you through how to do that, where we can be your broker and your representative and help you get a custodian. So with this week's Precious Metals Market Update, this is Tom Cloud signing out.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years' experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. All right, friends, welcome back to the program. And to this week's trading tip, I want to talk about 6 rules for selecting winning growth stocks. You know, over the years, I've learned that I prefer trading blue chip stocks for smaller profits as opposed to trading fast-moving growth stocks for larger profits. Now, don't get me wrong. I love to trade winning growth stocks. But because I trade for income, I prefer to trade lower volatility and higher probability setups. To give you an idea, 60 to 70% of my personal trading is focused on small moves in blue chip stocks. However, the other portion of my trading capital I reserve for the more speculative trades, including high-flying growth stocks, commodities, and country-based ETFs, and even penny stocks. When I look for growth stocks to trade, I start by looking for companies that I would actually want to own for the long haul. With over 5,000 stocks in America alone, you can afford to be choosy. So here's a few of the rules that I personally apply when selecting a growth stock to trade or to own. The first thing I do is I look for at least 20 to 25% growth in the company's earnings for at least the last 3 years. This also applies to the latest earnings report. In addition, I want to make sure that earnings growth is accelerating. Number 2, I like to look and see over the last 3 years of sales figures to make sure that they're rising by at least 20 to 25% or more and accelerating. Number 3, I want the stock's return on equity figure, known as the ROE. I want that to be at least 15%. Number 4, I focus my search upon companies that are committed to innovation. Keep your eyes out for new product launches and unique service offerings, as these often precede big gains in earnings and share price. Number 5, I check to see that the company has at least some institutional ownership. That is, I check to see if the stock is owned by any mutual funds, hedge funds, or other financial institutions. This is always a good sign. Ultimately, a stock can never maintain a sustained rise in share price without a strong and growing amount of institutional ownership. And then finally, number 6, always use a stop-loss order. I always use one no matter what when it comes to growth stocks. Limit your losses by always using a stop-loss order. I typically place my stop anywhere between 7 and 10% below the purchase price of the stock. And while these are certainly only just a few of the important factors to consider when selecting a growth stock, these 6 rules are a great starting point. There are many great growth stocks out there that meet these criteria. Why not limit yourself to only trading good quality stocks? By so doing, I believe that you will greatly improve the odds of achieving long-term trading success. Hey friends, Jerry Robinson here from Follow the Money. Are you ready to learn how to trade the financial markets? Or are you ready to take your current trading to the next level? I want to show you how to trade stocks, commodities, currencies, and options for consistent profits. If you're ready to learn, I'm ready to teach you. In fact, we have created a very powerful trading software and education system that provides you with entry and exit signals on every U.S. ETF and stock. Our powerful system allows you to identify the current trend in any U.S.-based ETF or stock with high probability entry and exit ideas. You can use our software on any device, and you'll also get access to ongoing live trading coaching videos. Whether you're a complete newbie to trading or whether you're an experienced trader, you'll love our live video coaching calls held every Tuesday and Friday morning during the live market hours. In addition to ongoing training through our videos, you'll also receive our best trading ideas every evening in our nightly trading report, in which you can log into our website and check out the latest uptrends and downtrends, along with many other high probability trading ideas generated by our system. A lot of people already know how to trade, but they just need a coach. They need someone to help them along. And if that's you, you have found, I believe, the right solution in our trading software and education system. And right now, we are running a very special deal for 7-day free trial for our entire trading system. Try out our system. See if it's right for you. Complete, unlimited, and unrestricted access to everything. Simply go to ftmdaily.com/pro and sign up. Choose either monthly or annual and get started today. ftmdaily.com/pro.
Hello everybody, this is Mike Mitchell with Strategic Wealth Partners and Christian Advisor Referrals. I'm coming to you again today to have a discussion about your sound retirement. I want to talk to you about the basics of setting up a retirement plan. What's important when it comes to establishing a good retirement plan? Well, there are some basics, and the very first basic is to have a plan. A very long time ago, a very wise man told me, you either plan to fail or fail to plan. You should have a plan. Actually, not having a plan is in essence having a plan because it's what you're doing. So you need to discipline yourself to establish a plan. Step 2 should be you should eliminate as much debt as you possibly can. As you approach your retirement years, it's very important to have as little debt as possible. I would recommend that you start with all consumer debt because that is debt that doesn't recover any cost, that doesn't build any financial wealth for you. It's literally a debt black hole that you fall into, and you need to eliminate that as quickly as possible. But when you approach retirement and when you're actually going into your retirement years, you should probably try to eliminate as much of your real estate debt as you possibly can as well. Step 3 is you should have a working, functional budget. You need to know what your core expenses are. What are your primary needs? And then establish a core funding mechanism to meet those needs. That's very important to have that well planned out. Step 4 is you should stay productive. Now, productivity is an important item as you are entering your retirement years for transition. It will help you to transition into retirement both from a mental perspective, from an emotional perspective, and from a financial perspective. It's very important to understand that you're going from an environment where you're engaged, you're focused, you're working, you have an agenda, you have a daily routine and a regiment, and you're now going into a period of time which will not be very structured. It's important that you stay productive. The final step that I would recommend to everybody is take it slow. As you move into retirement, you're going to find yourself with lots of opportunities to do a lot of things, and taking on too much too soon can be dangerous. So I would recommend that everybody, as they approach their retirement years, take it slow. Move into this transitionary period of your life slowly and purposefully. So I hope these ideas and these steps and these thoughts are helpful to you today. Again, here at Strategic Wealth Partners, we want to invite you to come and let us help you in any way we possibly can. And again, we would like to invite you to call our toll-free number, and that number is 833-370-0777. Again, that's 833-370-0777. This is Mike Mitchell from Strategic Wealth Partners and Christian Advisor Referrals, wishing you a very sound retirement.
All right, Mike Mitchell is one of our founding members of the Christian Advisor Referral. And he can be reached at 833-370-0777. I think that if you're looking for a retirement advisor, Mike is going to be one of the better folks that you've ever sat down with. And you know what people like about our Christian financial advisor or our Christian advisor referral service is the fact that the advisors are faith-based. They come at the planning process from a biblical worldview. And if that is what the worldview you share, then that makes a big difference in the planning process. If you want to talk to Mike Mitchell, give him a call. He's standing by, 833-370-0777. Well, friends, that brings us to the end of our program. Thank you so much for tuning in and allowing us into your life each and every week right here on this broadcast. You know, the Bible tells us in Proverbs 14:23 that all hard work brings a profit, but mere talk leads only to poverty. No amount of talking about your future will change it. Your future will only change when you decide to act. There's no substitute for hard work. So stay focused on your financial goals and you'll succeed. Until next time, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.